Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
Ready to rock?
All right, welcome everybody. Okay. So we have a little bit of a new format here.
You can see we're in our new little studio.
Yeah.
Okay, so we're good. Credit default swaps are up first. So Paul, you want to speak to these a little bit?
Sure, yeah, this chart's a little different than ones we've shown in the past. This really breaks it out by company. And this looks at, a random sampling of, say, several from the top 50 of the S&P 500 or so. And as you can see, credit default swap spreads are elevated for several companies, which is above normal.
Above normal. And again, as we always say, it's not just one indicator that we look at, but we look at all of them together. But this along with some of our other indicators, and maybe if some of you have been watching what's been happening over in Japan, maybe not UK, maybe we can speak to that a little bit today, Paul. I don't think we prepared for that, but it might be beneficial to talk a little bit about what's going on over there in terms of stress. But what we want to see is we want to see these levels lower, of course. But when we see it in conjunction with some of the other stresses we see, then we have to start paying a little bit more attention to what's happening in this particular area.
Right. And why do we watch these again? They're sort of a measure of risk, or they're the cost of a instrument that determines, what the risk of default is, or the likeliness of
it's insurance premium.
Yeah, it's an insurance premium.
The bigger the insurance premium, the more the risk. Really, in a nutshell. Okay, cool. I don't need to. Yeah.
Next slide.
Next slide.
All right.
All right.
So
spreads.
This specifically looks at BBB rated bonds by industry.
Yeah. And now the reason we like this, so this was one of the first indicators that I used back in the financial crisis. And I say this every time in the tech bubble, that gave me an indication of where there was risk. It got me out of Enron and WorldCom. Why? Because when spreads widen relative to the risk-free bond, it tells you that there's more risk. Now you can see this is elevating. Now, if we looked at this, unfortunately, this slide is really far away from me, and Paul's a lot younger than me, but I can't see how far back we go here on the years. How far back?
This is about 2 years.
Yeah, that's not long enough. If we actually went back and looked at the spreads back in 2007 and then in 2000 and 2001, you would see that these, although the trajectory is in the upward direction, understand that looking back historically, these aren't that bad relative to what we had back then. The direction, however, is important to us, and you can see the direction is sloping in the positive direction. So we don't like to see that. That means that the street is beginning to think that there's a little bit more risk in bonds, which, by the way, is the smart money.
Right. And so in order to be attractive to investors, these companies need to pay a higher interest rate that is above what the current Treasury bond interest rates are. And that's what this chart tracks pretty much.
Exactly. Okay. So that's bond spreads. Let's see. Next slide, please.
Right. So this is the leading economic indicator. The blue line is measuring the percentage change, looking at, I think it's 6 months. And this is directly from a government website, the conference board. The red line is when they sort of signal that, look, this is definitely recession. It's just triggered. I mean, we were saying that we were headed here, what, 6+ months ago?
A year ago.
A year ago.
Yeah.
Even. And the data here doesn't look good. And then again, remember the leading economic indicator sort of tracks a basket of different pieces of economic data that track the health of manufacturing, the consumer.
Yes, consumer, including
housing,
the housing, including the stock market and interest rates. So I can see on this slide, it's showing the red line there, and it's saying, okay, we are heading into the negative. And remember, the market predicts 6 months ahead of time. So market was already saying we're heading in that direction. So the question is now, over the last, 5 days, 2 weeks, Paul, the market's been bouncing, has it been?
It's a week or two, yeah.
Yeah. And that would be one of the factors that you would see next month. Maybe you would see a tick up in the leading economic indicators, but this is little dated, about a week old on this one?
This is from last month.
Yeah, okay. So this month we'd probably see it tick up a little bit, but doesn't matter. You see the trajectory is in the downward direction. You can see during Corona, we had a deep spike down and a quick recovery. That's very unusual. Usually it's more like what you see in the far left side of the panel there, where there's a little bit longer period of a time for the recovery on the in the leading economic indicators. Okay, next slide.
Next slide.
US dollar.
Right. So here's the dollar, and this goes back to 1972. So you can see those spikes, and we've talked about this several times, that each spike really is during times of uncertainty or crisis. You had 1984, 1987 was that initial big spike there. 2001 was the one right in the middle. 2009, it doesn't show up too much on here. Is that?
Where is that, Paul? That's just before.
It's about 2/3 of the way from the left to the right.
Oh, this is really hard because we can't from here. We're going to have to change that. So bear with us here. But one of the things the point that Paul is making here is that with each crisis, the dollar, keep in mind, the dollar is considered the safest currency in the world. It is where the world turns for safety, is the US dollar. It's what most all goods and services are traded in the US dollar. But what this chart is showing you is that with each externality, with each crisis, the dollar, it goes up. But today, even the dollar isn't hitting the high that it hit previously.
Right.
Previously.
It still hasn't gone above its high from 2000, 2001 time.
Why is this significant to us? Because again, some of you may know this, we are of the mind that the dollar will not be the reserve currency in the long term. And you can see now, and one of the biggest concerns Paul and I always talked about is that OPEC now is starting to move against the United States a bit. It's starting to kind of push up against us. Now, keep in mind, it's called the OPEC dollar. This is what almost now, not all oil gets traded on, but almost all energy. So if that pivots and that changes in any way, and our thesis is that the dollar will turn in the other direction. So what we would want to see to know that the dollar is healthy, well, one, we would want to see a little bit less, let's call disruption in the world right now. We would want to see maybe more friendly policies between countries would be good, and less posturing against the dollar, which is happening now. But technically, we would want to see it go above the previous high back. And again, unfortunately, I can't point it out because I'm not there. I'm almost tempted to walk to it. But the previous high, we want to see it hit above that. Then we'd say, okay, we're hitting a new trend. So even though the dollar's been doing well, you're reading about it in the headlines that we're hitting a new high, but it's only a new 52-week high, or only a new 10-year high. It's not a new high.
Right.
So this still is something we have concern about long term. And this is significant for us because if the dollar turns in the other direction, goods are already getting more expensive. It will become significantly more expensive if it turns in the other direction. So in other words, for inflation, we really haven't seen much yet with inflation.
All right.
All right, next.
Yeah, so this sort of continues on our dollar thesis, which shows this chart goes back to 1999. The line on top is how much of the world's reserve currencies or global foreign exchange reserves are denominated in US dollars. And in 1999, that number was 70%, meaning all the other central banks around the world had 70% of their foreign exchange reserves denominated in US dollars or in US dollars. Since then, it has dropped to 59%. So that's a 11% drop
12%
over
drop,
20, 30 years, which,
Yeah.
these things can take time, but it just shows this erosion of dependence on the dollar.
Yeah, this is great because see, I actually have the charts
There you
over
go.
here because I can't see that far.
Yeah.
But the red line there shows other.
Right.
So this other is the emerging markets. So it
Yes.
would be Brazil, China, Russia, and India would be the other line. And you can see actually, if you look at the slope of that line, it's increasing. This doesn't surprise us because a few years ago, what was it, Paul, in 2010? No. What? Oh gosh, these years. Was it 2015 when they announced the beginning of their own World Bank? Or was it
15,
okay.
16.
Okay. So this doesn't surprise us to see that this is going in the upward direction. Again, this is significant because you have to remember we import so many of our goods. It's very important that we have a healthy US dollar, not too strong against other currencies because that creates problems, but the sweet spot. And if we lose that status, we will see again prices of import goods go much higher. So I'd venture to guess that red line will see a much. This is a little bit. How was this from 2001 to 21? Is this the latest? This
is the most recent IMF report.
Okay,
on it.
so it's probably about
little bit
6
dated,
months,
but
six
but
months dated.
fairly recent.
Yeah. Okay. Let's talk about the next slide. Yield curves.
Right. So here is just a simple way to look at the yield curve, basically starting from left to right. It shows you all the different 3-month, 6-month, 1 year, 5-year, 10-year, all the way up to 20 or 30 year on the right hand side. And then what the corresponding interest rate is with that on the what is that, a y-axis? So what this is saying is that when you buy on the short-term side, so anything basically under 2 years, you're getting paid more than if you were to take on longer-term 10, 20, 30-year debt. That is not typically a sign of health. You would think that if you're going to lock your funds up for 30, or 10, 20, 30 years, you're going to be paid more for it than if you're going to lock your funds up for, say, 1 year or less. But that's not the case. Typically, these curves invert before or during recessions, right?
Yeah, usually they're telegraphing a recession ahead of time. So this would have been factored into that leading economic indicators that we were discussing.
Right.
This would be factored in there. So this inversion is a sign that something. So you'll notice that the markets rallied over the last couple of weeks. And some of this has to do with the fact that there's been now more conversation that things may be slowing down, right? So
some central banks out there raised rates less than they said they would.
Yep.
I just saw this morning, Bank of Japan's doing a $200 billion stimulus to combat inflation, which doesn't really make sense. But okay.
We're grasping at straws, I think.
It seems like
this unfortunately it's been this what we're up against economically is not something we've experienced in my career. When I started, we were in a high inflationary environment, but we were coming at the end of that. So a lot of the policymakers do not really have experience in this type of situation. And one of the things that we keep saying is, and we can get to that in maybe the next slide. I'll talk about it in the next slide, but slide after that. Sure. Just let's keep going forward. Next slide.
Yeah. Okay. So this is just another way to show U.S. Treasury yields on top. Those are the charts of the 2-year, 5-year, 10-year, and so on. You can see how drastically rates have increased and the yields on these bonds have gone up considerably.
Mhm.
They are super tight right now across the board.
Mhm.
What the bottom shows is what all the other countries' central banks have done. And you can see actually that while the US, I believe, has raised generally the most,
Mhm.
the outliers being Japan, which has sort of locked it in, but they're doing their own thing. That's how it looks.
Yeah, Japan's had to intervene in their market quite a bit because
For
of, yeah,
decades, really.
yeah,
Mhm.
yeah. So, okay, so let's look at the next slide. Let's talk about inflation. Again, this is the one that Paul and I look at. This is shadow statistics because, again, this is the original basket. This isn't changing things out when things don't look good and so on. And you can see the trajectory, the line there is straight up. We, again, don't believe that the Fed is going to have enough of an impact on inflation because most of the price increases you're seeing are in things that people need: rent, food,
Mhm.
energy.
Yeah.
That's a big one.
Healthcare,
Energy, healthcare,
education.
yeah, education. I think education
Mhm.
may see a little bit of a slide back with less people going to college
Yeah.
at the enrollments down. So, but something somewhere along the line has to be recalibrated. Hopefully, we'll start to see a slowdown here, because this is what the Fed is raising rates because of this inflation. We think they are behind the times. They should have been doing this quite a while ago and not this aggressively, because this is really concerning.
Right. And
The
one thing
pace-
to remember too is when the Fed makes its policy, it's usually at backwards looking data
Yeah.
or stale data, and then saying, okay, our numbers are still high, even though this was on data from last month. We're going to change
Mhm.
our direction or increase rates this way, and then see what happens over the following month.
All right, so let's go to the next slide. So this shows the breakdown that Paul and I are talking about. The dark blue line there, or black almost, is energy. And then the blue line, the lighter blue line, is food. And then the green line there is all items less food and energy. So you can see the majority of the increases in food and energy. And again, how much can the Fed control this? Because we think most of what's driving the prices here is not the economy, but rather policy. We think that it's basically policy that's driving up prices. Food, for example, the conversation we are now having around lowering carbon emissions and the effect of that on the cattle industry, for example. So there's a lot of reasons why we think these two areas are going up, and it has definitely more to do with the policies that are being put in place.
Right. A lot of discretionary spending, stuff that isn't necessarily necessary. Prices have come down for some of these things. Clothing, some electronics, definitely not all. Discretionary spending in general. Prices on these things, or many retail stores are saying how they bought all this excess inventory thinking that the post-COVID boom was going to continue forever, and it kind of turned out to be the wrong decision to make. So while they try to offload that supply, prices for those things will go down, but at the end of the day, what do you need to survive? Food and energy, these things are more structural in nature. What's happening with those markets due to global supply chain disruption still happening and global conflict and uncertainty. Not to also mention things like climate disruption that is devastating certain crops and so on. So there's all these continued pressures that interest rates and those kind of things really won't have an impact
and policy. So I just want to share
the policy. I wrote that down.
Unthoughtful policy. I just want to share with you, and you please look this up. But in Holland, you can see that farmers are outraged because they are told that next season, not this October next year, that they are not allowed to plant anything. So they typically plant Brussels sprouts, cabbage, kale, the winter crops, spinach, things like this. They're not allowed to grow those next year, and they're only allowed to grow Chinese cabbage and only a certain amount. Now, this is a fact, but why? This is a fact. Please look it up because it's out there. Why? Now, in a period where we see food prices rising, this is not the time to be dictating to the farmers how what they should be planting and how they should be going about planting it.
Right.
So now it's under the, perhaps the policy is because of energy, but
Input costs,
input costs and
fertilizers,
all that
those
kind
kind
of
of
stuff,
things.
yeah.
It's under the guise of, okay,
Yep.
if this is
But-
a nutrient dense crop
yeah.
that requires less inputs than these other things, so therefore it should benefit
yeah.
more people,
But
but it's just not a really thoughtful way to think
It's a
about it.
story to watch.
Yeah.
Please watch it because I think it's significant. Okay, next slide. I think we really brought that home. Now, this is the inflation. This is food, and you can't, even your little eyes can't see that from there. You know, you're a lot younger than me.
Well, I wrote some notes down. For
Okay,
it,
you did.
but right,
'cause I
this just shows, the price of food has been going up, and it has more to do with, again, policy and structural issues, because if you look, the price of what is it, milk, beef, these things have been trending up since 2016, 2017. So this is well before COVID or any of the supply chain disruptions that we're experiencing today. So what we're seeing is that there are structural issues in these markets that raising interest rates will not correct and will not fix.
Not
fix
unless you're
these,
dealing
right?
with policy.
Yeah, so-
All right, next
Next
slide. The cleanest dirty shirt.
Right. So we've mentioned before, this sort of dovetails
I'm
back to
looking
our
at this.
conversation about the dollar, about, where else, what would replace the dollar in the event that, the world decides to move to a different type of reserve currency. People have always said or thought like, well, the US dollar is the cleanest dirty shirt of the bunch. But when you look at the US economy as a whole, I mean, this tracks the S&P, this looks at all different indices of, I think, 20 different countries. And the US isn't doing that great
This year.
this is a year-to-date chart.
Yeah.
Right. So is it still the cleanest dirty shirt? It's a
Well,
bigger question.
Yeah, but for a lot of years, it was, we were dubbed the cleanest dirty shirt. Why? Because we know that a lot of the policies that were put in place after the financial crisis were just policies that were kicking the can down the road. And we're experiencing the effects of those policies today with this higher inflation rate, for example. And so it was just an industry saying the cleanest dirty shirt is the United States. Well, we argue now, and this is something you will start to see with our portfolios going forward, is we're starting to look in other areas of the world, not simply because we're underperforming, no, but because of the policies, the potential for growth, less inflation than what we're experiencing here. Some of these countries may have a little bit more energy independence. So we are starting to look outside of the United States, and we find it interesting that after really decades of a good decade of outperforming, we are now definitely underperforming the world.
And everything moves in cycles. And, the past decade plus has been the US's turn, right? We'll see what happens going forward.
Okay, so let's move on to the next slide.
Right. So we threw this chart in this morning. What these lines are showing are defense companies, US defense companies. And you can see over the past few days, really, the past week, they've all started spiking. Now, Alexandra, you have some experience and insight with seeing these types of spikes happen, being that they...
Yeah, let me explain that to you. Yeah. So bottom line is, we said that the market is a leading indicator, and it's a leading indicator in everything. So for example, last summer, I want to say somewhere around August, September, Paul and I took larger positions in energy because the market was telling us that prices were going higher, period. So we said, between the fundamentals of the company, low PEs, decent dividend, really good dividend, actually, when we bought some of these things, and the fact that the charts were performing like what you see here, they were starting to perform well, we took on a big position. Subsequent to taking that position, we saw energy, we don't need to tell you what's going on there. What this is showing us, these are the major defense companies. What this is showing us, and actually, I think we've now hit new 52-week highs on some of these things.
Yes, on a few.
Oh, I hate this, because when we see this happen, this usually means that we're going to war. So even though there's a war over in Ukraine right now, what this chart is showing us is that is going to amp up from here. And I hope we are I
This
literally,
is one
I
I'd
want
really
to
hope
be
to be wrong
completely
on.
wrong. This is, I'm hoping I'm wrong, wrong, wrong,
Mhm.
wrong.
Yes.
But that's not what this chart is showing us. And it started to move up over the last, now granted, the market's moved up over the last 2 weeks, but this started to move up in that time period. But
Yeah,
this acceleration.
And
is
it's worth
significant.
noting too, while the market's moved up, I think 9% or so from its last low, it's still down 20%.
It's
year
still
to
down
date.
20%.
Some of these are hitting
New
new
50
new
yeah,
highs,
new highs.
new all-time
New
highs
all-time
for
highs.
some.
So this is
Mhm.
telling us that things aren't going to get better here.
Mhm.
This is going to
It's
get more challenging.
Definitely concerning.
Yeah, I don't like this.
So I added this line of 3 fronts because it seems like the rhetoric, and we won't get into it in this call, but it seems like the rhetoric is conflict could be escalating with Russia. There's a lot more talk around OPEC and conflict
OPEC.
between the US and OPEC. And then the same with China too. We've seen
Not the
an
time.
amp up of
Mhm.
what's going to happen with Taiwan and just China in general.
And we didn't put the energy charts in here, but you would
Mhm.
actually see the energy charts are starting to go higher too.
Mhm.
So please know this, we're going to say this on the record right here. After the election, we do think we are going to see substantially higher prices at the pump
Mhm.
and heating oil. So we're just going to get a record. That's what we see. That's what we think is going to happen for a number of reasons.
Yeah,
so,
there's a lot of structural stuff and policy that has not been addressed. And yes.
Okay, so let's get to the next one because this is gold. And so we would think that
Right.
everybody would be running to gold.
Yeah, and we had a question come in from someone attending about what our thoughts were on gold. So
yeah, might as well address it here.
Wanted to share these, wanted to get some charts in because we're away from the computer, so we can't just pull them up, but show you that gold is down about 20% from its high. You would think with all of the conflict and uncertainty out there in the world today, it would be, flying through the roof.
Yeah,
it's not. So that is saying something.
Yeah.
It's historically been seen as this, safe
safety,
haven,
safety.
Store of value type thing. But
what will be curious for us is to see how this performs if the market were to reverse course and see what we would have to see is we would have to see it go above its high. Right now it's at support levels. If it breaks this substantially, I think it's a little bit below support. If this breaks below. If this breaks this in a meaningful way, then maybe it's not the store of value that people think it is.
One of the interesting narratives that I've heard was that because gold has become so financialized over the past 20, 30 years, that there's so much paper gold trading out there that the entire market is just going to have a much closer correlation with stocks than it used to in the past.
We do know that central banks around the globe are buying gold. So that is absolutely indeed the case.
Eastern banks.
All right, so let's go to the next one. This is just gold non-dollar denominated.
This just shows how the bottom line is gold priced in USD. And if you were a non-US citizen and in another country and you held gold, you probably would have fared better than holding onto your own currency. But it's still, I'm not overly inspired by any of these charts, really.
Okay, so let's get the next one, then we'll get to questions. So finally, what keeps us up at night? This is the slide Paul and I used last year, August and September. The same thing holds, power consolidating to the top. We still see this occurring at the corporate level, at the wealth is still consolidating to the top. So that's happening. Supply chain disruption. This is very interesting. I had a phone call conversation today with someone in the manufacturing industry who's still baffled why we're still having supply chain issues when supposedly there's not as big issues at the port. So that was concerning. He is concerned that he's not able to get the goods that he needs to create his end product. So that's still happening. Why, it's a bit of a mystery, but it's still happening.
Yeah, one thing I had heard recently was how we'll see what China does with their zero COVID tolerance, where they lock entire cities down. That might be lifting soon, which could be unfortunately a huge tailwind for inflation, because as these cities move back online and open up more, there's a lot more demand for things internally in China, which will bring energy, commodities, all
Everything
these
up
things
high,
up
right.
significantly. So we'll see
Yeah,
how
we'll
that
see.
plays out.
Yep. And then stagflation, we do still think that we are in a very strange environment. We call it reverse stagflation, where the price of necessities are going higher. There's no question.
Yeah.
And then the last thing is civil unrest. And, we do see more tension, and we're here to say, don't do it. Don't have more tension.
I know
just
there's so much rhetoric out there,
Mhm.
extremes on every side,
Yeah.
trying to get people
Just
fired up
resist.
over things.
Yeah.
It's
Resist.
unfortunate, really. And you have complicit media and complicit social media platforms that,
Mhm.
rely on algorithms that, not to get too far into the weeds, but they really promote outrage.
Yeah,
Right.
so let's not be outraged with each other, because I really think this is a time we could be facing war. We don't know, but this is definitely the time where we can't be turning against each other by no means, no matter what. And so anyway, that's my plea on that one.
Right.
And that's
Thoughtful
the
policy, and all it takes is having a conversation.
And the thing is, we are not powerless. So I do want to say that we've been meeting with a lot of clients over the last couple months, and a lot of people are a little discouraged. And I get it. I understand completely. And I always say, I call my senator, I call my Congress people. They probably know me. They probably think, oh God, she's calling again, to say, how I feel about things. Like, look at this inflation bill isn't going to do anything for inflation. What are you doing? 87,000 IRS agents isn't going to put food on the table for someone who needs it. They don't pick up, as and don't call back, but at least I leave my messages lovingly to say, I don't want a war, figure out a way to create peace. I understand we have to be cautious and so on, but I don't want a war. Find a way to
Right.
maybe not beat our chests and sit at the table if it's possible. So just so you know, we're not powerless. We can put some pressure on our politicians for whatever it is you want. I mean, whatever it is you believe in. I want people to have food. I want thoughtful regulation and thoughtful, I am one that believes in green energy. I'm all about it. I have green energy, but not at the risk of not allowing someone to afford to be able to heat their own home. Let's move towards renewables smartly,
Right.
not just rip the rug out. That creates a problem in the long run. So these are the kinds of things that I call about. I encourage you to do the same. If you want peace, or if you, whatever it is you want, I'm not going to tell you what you want, what it is you want. We do have that power. We really do have that power. Our voice, it matters. So I'm pleading to you, use your voice, love each other. My gosh, because who knows what we're up against at this point. So now, just one thing we didn't touch on is how we're positioning in the market right now. We want to maintain what?
Can next slide.
Oops,
Yep,
we have
nope,
another
nope,
slide.
that's
Oh, no,
it.
I didn't think so. I
Yep,
thought
so
we were
can,
done. Yeah.
Go to full screen here.
Yeah. Okay. So what I want
There we
to talk about is, how are we positioning in this environment? So right now, we're maintaining a very conservative strategy. We don't want to take on too much risk until we have some more data coming in. One, we want to wait until after the election. We think that has the market very captive at this point. And we want to see what's happening. War is not good. Okay. Like there's a time, many times, and this is really unfortunate. And I will say in my career, what I've seen is war will sometimes prop up the market. This is a different situation, right?
Yeah.
So we wanted to see how things go. And I think even more importantly, not more importantly, but equally important is the Fed, the position of the Fed. The Fed's been raising rates very, very quickly. So quickly, I am not comfortable. And in my mind, and this is one of the things this is why I called our Congress people. I said, they're moving so fast, they are going to create a problem. Other countries around the world have been saying that they're moving too fast. Companies and corporations in the United States are saying they're moving too fast. They're raising rates too quickly. So if they continue this trajectory of raising too fast without stopping and waiting and seeing the effect of what they put in, this is a concern to the two of
and
us.
to drive that point home, I saw a chart recently that showed all other times that the Fed had aggressively raised rates, and this is by far the steepest curve
in my career
ever.
in
Right.
my
And
career.
so what that
E-
also signals is, right, the grand economic experiment, right?
Yeah,
It's
even
just, they
even
don't
under
know what's
Volcker,
gonna
he didn't
happen.
raise rates this
Right.
quickly. This is the fastest ever. So you have to understand, it was the rate increases in 2007 that spurred the financial crisis. It's the rate increases that also was a contributing factor to the tech bubble. They all came on the heels of Fed raising rates. So this, to us, if you're going too fast, you're taking away the punch bowl very quickly. You're not seeing the net effect of policy. That is the number one reason why we say, let's stay short term.
Mhm.
Let's have some bonds in here, just
Right.
in the near term.
Much
just to
more
keep it going.
conservatively positioned overall.
Yeah.
Makes a lot of sense based
Yeah.
on the data that we're seeing.
Yeah. So hopefully we'll get a better feel for that. I think after the election, we'll have a better feel for the Fed's posture at that point in time. And you can rest assured that if the Fed says we're stopping, we're going to halt, we're going to chill out, then I can tell you, we're going to get definitely more interested in having
Sure.
more allocation towards equity. But we need to see reason there, just a little bit of a slowdown in
Mhm.
order for us to feel comfortable there.
Makes sense.
So what questions do
All
we
right,
have,
so we
Paul?
had several questions come in.
Here we go.
We answered the one about gold. So that's
Okay,
great.
good.
We did have a question come in around oil prices and where we see them going over the
Yeah.
next few months.
Yeah, higher.
And well, simple, higher.
Higher. Again, okay, we have the externality of war. We definitely do. We have some policies here that are,
Mhm.
you know, I don't
Right,
know if you.
it's war, unthoughtful policy across the board. This isn't exclusive, or
It's just, yeah,
inclusive to
please
just the United
bipartisan,
States. This is
yeah.
all over the place
All
too,
over.
even Europe,
Yeah.
all over. Or issues with OPEC, rising tensions there,
Mhm.
and then potentially the opening of China too.
Mhm.
We're reopening of China, which could put huge pressures on an already constrained.
And going into the winter
mhm,
now.
right?
Now,
And
yeah. Now we've been pulling from the strategic reserve too,
right.
at a pace that's really uncomfortable, because I think this is the lowest our strategic reserve has been, Paul,
It's I
in
believe
the
so,
last
yes.
3 or 4 decades.
Since the 80s or something
Yeah.
like that. Yeah.
So we're at the lowest. So they've been pulling from the strategic.
And
oil
remember
reserve.
too, this oil is supposed to be used
In the case
for
of emergency.
emergencies
Yeah.
internally within the United
Yeah.
States.
So
When you look at flows of oil, the unfortunate thing is that this oil is being sold.
it's being
and
sold
global
to
markets.
other countries. So this is our strategic oil reserve that they also pumping into this economy. It's not just going overseas, but that's what if you remember, just before summer came, we saw the peak in gas prices at the pump, and then it came down. What's because of this? It's because of we're pulling from the strategic oil reserve. So we don't think that that's going to continue. Honestly, after the election, we don't think that they'll continue to pull from that. They shouldn't anyway, because it's not an emergency at this point in time. That is not a strategy long term. So we think higher prices. So if you had to, hopefully you locked into your contracts for oil.
Or alternative heating sources.
Or alternative, yeah, so I'm hoping some of you know that in Poland, they're burning their trash to keep warm in their house. And in parts of Europe, their prices have gone up exponentially. So we are really quite blessed in this country to have some really good sources. But I can tell you that there is already conversations about there being gas shortages in the northeastern part of the United States. So this is already up for discussion. So if we were to speculate, we would say higher.
Right.
Sorry.
All right.
I can't lie about how I feel about things.
So next question is, what's our take on index funds, world funds, total market funds?
Okay. Index funds we don't like right now because we don't think it's there are times where index funds are great. When you're in a bull market, that's where you can do really well.
Agreed.
But this is not the market for that. World funds, we are starting to have our interest peaked in other markets.
Right. There has been some interesting data. The way certain charts are forming up is signaling to us that there might be some opportunities.
Yeah. So that might be a place we'd be nibbling in the portfolios is there. What's the other one, Paul? World funds.
Yeah, world funds, total market funds.
Okay, we're good. That takes care of that
So our
question.
take on tips, Treasury,
Treasury inflation protected securities.
Versus Series I bonds.
Mm.
And so there's been a lot of talk lately around Series I bonds because they're yielding something like 9% or something like that. But most people don't realize there's a limit on how much you can get. I think you can only invest something like 10 to 15,000 per person, period. Right. So for a large investment, for a little bit of cash to, lock up for a year plus, because there are some penalties if you try to withdraw it, I think before 3 years or something. It's not a bad place to put some cash.
Yeah.
But you can only do small pieces.
Yeah, small doses.
Relatively small.
And what we're doing is we're buying short-term treasuries in the hope that we can roll them out into other treasuries or into the market. So we're keeping it really short so that we can put it in the stock market if we feel like it's time, or we can get into higher rates. So we'll see what happens as the time goes forward.
All right.
What else do we have?
Question is thoughts on dollar cost averaging into an annuity for retirement.
That is an individual question. Yeah. So whoever asked that question, you should definitely
give us a call.
Yeah. We're not big, let's put it this way. We're not big proponents of annuities at all for a number of reasons, depending upon the type of annuity that it is and how it's structured. It can become an asset of the company where you're getting the annuity. So it could actually become an asset of the insurance company, and it goes on their balance sheet and not yours. So it depends upon what it is. And whoever asked that question, we advise that you ask us individually. Yeah, please.
All right. And last question I have is, will the stock market even survive?
Good question.
So this is something we've talked about ourselves internally of, what do we think?
Paul and I always have these conversations like where things could potentially go in the future. And sometimes, I want to say, I don't know, 12 years ago, I said, Paul, I wonder sometimes if the market's going to be extinct. I mean, this is not like we haven't had these conversations. Why do we say this? We can't say whether the markets are going to be here. This is what our system is based on.
There will always be some type of exchange that people do, locally, regionally, globally, and it will rely on some type of infrastructure and some, will the future market look like the market does today?
I don't know. Yeah.
I would argue it will probably look a little different.
Yeah. So everything evolves. As you know, we're involved in the crypto market because that definitely still has our interest, despite the fact that it has pulled back. The best way we can say this is that we think everything is an evolution and everything ebbs and flows. And I would say that many things are telegraphed for us. And so if there is a problem with the markets, if there's not going to be a market, we certainly would see a massive correction. I think we would start to see evidence of that. Are we concerned about corporate America? Yes, for a number of reasons. We think employment is a big issue. We think some of the value systems in the US companies are an issue. There's a number of reasons that we have concerns. Do we also think that some companies are running away with profit? Absolutely. They're taking advantage of what they're seeing here with this increase in inflation. So I think the bigger question for us is, are US companies behaving properly? And we think
no,
not really.
Yeah.
So this is truth. So
let's see.
What else do we have?
Two other questions. Let me just.
We have more questions coming in. I hope you like this. Paul, you didn't put on our lights. Are we supposed to have our lights? He forgot to put on our lights.
Do you want to quickly flick on the bottom?
No, it's okay.
Right. We'll do it for next time.
I would though.
All right. So here's a question. Do we think the vast majority of sort of the pickle that we're in now, this mess, start with COVID fears, lockdowns, et cetera, or was it more and COVID policies were a distraction?
Okay, say this again.
Okay.
Read it again. Here we go.
Did all or the vast majority of this mess start with COVID fears, lockdowns, et cetera, or was it more than that? And COVID policies were a distraction.
I think that we've been heading down this path for a very long time. We've been, again.
I would say the COVID policies amplified
Yeah.
things and sped up a lot of the,
it sped up
the
a lot of-
stuff
yeah.
that
yeah.
was already problems that were working out there. This just sort of pulled it forward.
Yeah, but the tension's been rising
Mhm.
for a number of like decades, and some of the policies have been, flawed in our opinion. What else do we have?
All right. So the next one is if the Fed stops raising so much, you are more comfortable than investing in equities, which means stock market companies. Investing in equities, yes, does mean investing in the stock market. And does current situation mean you think we shouldn't be in the stock market that much and not owning companies, et cetera? Yes, I believe where this is going
What's the question?
is that are we comfortable, given that the Fed is continuing to raise rates, are we
Yeah.
comfortable being in the stock market?
Yeah,
Right.
this is why we're conservative right now. It would be really unusual for the Fed to pivot from raising rates to lowering rates, like boom, boom. Usually there would be a delay,
Yes,
like
yeah.
they'd raise and then they'd stop, or they'd lower and then they'd stop and give it some time. So,
Mhm.
yeah.
Yeah, if they
it's not
continue
the
to
time.
raise rates, right, it to us introduces more instability in the stock
Yeah,
market.
just for the time being, we just have to see how this plays out over the next couple months, but definitely.
Let's see if
Do we have more?
anything else. I think that might be.
Is that it? We don't have
Yes.
a way for people to raise their hand to ask a question anymore? I guess we don't.
Maybe, but we don't have a way to.
Oh, but we
access
can
it
even
from here.
look at
I have,
that
I
anyway.
have
Okay.
Christine sending me.
All right. Well, thank you
info.
everyone so very much.
Yep.
I hope that this has helped you. I just, I think it's really important for us to leave you with the note that we take this really seriously. We appreciate so much that you trust us with your funds, and what we commit to do the best that we possibly can for you. Given the years of experience that I have navigating different cycles, and it just seems to us right now that this is the smart way to be, just to be conservative through this period of time. We're facing
Right.
things we just historically have not faced.
We had a follow-up question come in that was like, when would we know when the time to get back in?
Okay, so you
markets
want to see the Fed stop raising rates,
Mhm.
and in the way it doesn't just like, oh, we're just going to stop. It's one of those things where Paul and I start paying attention to the Fed governor speak. What are they saying?
Mhm.
What kind of, because they're always out on the circuit speaking at different engagements, and you can actually look up what they're saying. So you want to see where the Fed is starting to move from being very hawkish to dovish, so for being really discussing raising rates and starting to back away. That's one thing. The other thing is, technically the markets will show what we call a consolidation. We never really have these V recoveries, like we come down and bam, we're back up. It's usually down and then consolidation.
Mhm.
So that's the other thing.
And then strengthening company fundamentals,
Yeah.
improved balance sheets, improved sales, improved outlooks.
Yeah, because sales are, some companies have better sales, better revenue, but it's because they have higher prices, but their sales are down. Be very curious to see how the Christmas season goes this year. That's going to be really interesting. But so the Fed, what's going on there? Consolidation, what's going on there? Improvement in the leading economic indicators, what's going on there? And then, by the time those things happen, the companies, you won't see a change in the balance sheets of the companies until those things are already in place.
Right.
Because
And a lot of it too
those come later.
is driven psychologically by
psychologically.
consumer, how are people as a whole feeling?
Yeah.
If there's, a lot of uncertainty and fear and discontent out there, if everybody's saying the world's bad, then the world's bad. Right?
Yeah. So right now, you want to definitely see a cooling off of any potential
shift in
conflict.
narrative too.
We want to see a cooling off of a potential conflict. I think that's really, really important. Do we have any other questions that came in?
That's it.
That's it.
Yeah.
Okay. Thank you very much, everyone. And if you have questions, give us a ring, 236-2980. We'll talk with you soon.
Thank you. And if you have any feedback, feel free to send it our way, or if you'd like us to dig into any topics at our next one, let us know.
All right.